Good morning, everyone. A very warm welcome to the third Income Tax Symposium, January 2026, organized by Educating and Tax Connect. I would now like to introduce our speakers, Mr. Vivek Jalan and Mr. Rohit Sharma. Mr. Vivek Jalan is a qualified CA, MBA, qualified LLM, and LLB. He's the partner of Tax Connect Advisory Services. He's the regular speaker at various professional forums, specializing in both direct and indirect taxes. Mr. Rohit Sharma is a tax professional and law graduate with over 18 years of extensive experience in both direct and indirect taxes. He is the joint partner in Tax Connect and a regular speaker at professional forums, seminars, and webinars. In today's webinar, we also have Ms. Pooja Garg as the moderator. Ms. Garg is a chartered accountant with over 19 years of professional experience, and she is the co-founder of Educating. During the session, please put your video and microphone off. If anyone has any query, please feel free to write in the chat box. We will address all the queries at the end of the session. Now, we request Pooja ma'am from Educating to say a few words. Over to you, Pooja ma'am.
Deepa, I think
So, ma'am will be joining in a minute. We request our speaker, Vivek sir, to take the session forward.
Yeah, sorry, Deepa. Actually, I was there, but my mic on mute. I'm so sorry for that. Thank you so much, Deepa, for the warm introduction. And I'm wishing good morning to all the people who has joined today's webinar. In today's webinar, we will cover key income tax developments, including Budget 2026 expectations under the Income Tax Act, recent landmark judgments such as Tiger Global and ORDA cases, and their impact on the DTAAs, charitable institution and international tax position. We will also discuss practical aspects like investment versus stock and trade issues, use of the ITRU for disclosures depending addition under Section 6869, and TDS on foreign agents, and other important domestic and international tax updates relevant for professionals. With this brief overview, I now request CA Vivek Jalanji to take over the session and share his valuable insights with all of us. Thank you, and over to you, sir.
Thank you, Pooja. Am I audible clearly, or is there a break in the
So, you're
voice?
audible clearly.
Clear, no? Yeah. In case
Yes,
there is any break in the voice, please let me know, right? Because I think there is some issue in the net connection.
Sure, sir.
So, good morning, everybody, and thank you for joining in today's third income tax symposium. Thank you to Educating. Pooja is there from Educating for partnering with Tax Connect for this symposium, and thank you to Pooja once more for moderating this session. I'll share my PPT. Is the PPT visible? Deepa, you are not.
Yes,
You
sir.
Yes,
mute.
sir, it is visible.
Hmm.
PPT is visible, sir.
Yeah, yeah. Okay. So, you see, today we have to discuss. We have, with us to discuss a host of topics. The income tax landscape in the country is completely going through a complete revamp with Income Tax Act 2025. Supreme Court judgments in Tiger Global case, which has revamped, I would, and unsettled, I would say, the settled space in as far as international and global tax restructuring or structuring is concerned. Also, there is a issue in the shares which you receive after amalgamation as a shareholder after a Supreme Court's very recent judgment. The litigations in income tax space, while the government wants to reduce it, it keeps on increasing little by little. So we'll discuss on the basis of our experiences and the cases which we in Tax Connect have handled, what are the issues and how best you can handle it. Also, in case of bogus purchase allegation, how to handle it in case you are a genuine purchaser for income tax purposes. So all of this is there, and along with me also Rohit is there, our joint partner. He would discuss on the Income Tax Act 2025 implementation. While CBDT and Ministry of Finance is saying that there is not much of a change, but the entire act is changing, and we from Tax Connect have analyzed section by section on this Income Tax Act 2025. And from what we can understand, a lot will change from 1st April 2026. So all those, from the consulting space who have joined here from industry, I think it is very, very important that from now we should start the Income Tax Act 25 implementation. Rohit would take you through the Income Tax Act implementation module which we from Tax Connect have prepared. Also, like in the last symposium, and now Pooja is also there, we from Tax Connect and educating, we are trying to bring out Income Tax Act 2025 master class for the members of educating and the businesses and consultants at large. So very soon, I think you would be getting the alerts from educating as well as Tax Connect on this Income Tax Act 2025 masterclass. So let's get started. And first is this Union Budget 2026, right? Which is very, very due very soon on 1st of February 2026, which is a Sunday. The Honorable Finance Minister will be proposing the Union Budget 2026 before the Parliament and the country. And whenever there is a budget from industry associations, we make representations, we go to the Ministry of Finance as also for pre-budget discussions with the Honorable Finance Minister and with the CBDT and CBIC and the officials of Ministry of Finance. And some of our expectations and some of our proposals are accepted. Some of them may not be accepted now, may be kept for the future. But it is heartening to see that many of the proposals which we have proposed and recommendations, they have taken shape in the last budget. If you see our interviews on various media channels including Z Business, we had proposed to the ministry, and we had predicted that the Income Tax Act slabs would change tremendously in the Union Budget 2025. We had proposed on the customs rate reduction on lithium ion batteries. So all of this, the ministry did take cognizance of, and very kindly accepted the proposals which various associations had put forward. In this budget too, While the financial year 25-26 has already seen a lot of tax reforms, not only in the income tax slabs, but also in the GST space. But in this budget, a lot is expected in income tax as we move into the Income Tax Act 2025. Now, from 1st April 2026, we would be into a new regime of income tax. So this budget would modify Income Tax Act 1961 only to a lesser extent, but possibly Income Tax Act 2025 would see amendments and modifications. As of now, the ABDT is claiming that there is no difference between Income Tax Act 1961 and 25 in the policy space. So we have few expectations from the union budget, and which we are bringing out to you. You can go to our YouTube channel, the Tax Connects YouTube channel, and every day we are bringing out the budget expectations from what we are getting from Delhi, from the various understandings on the budget. So we have around 8 to 10 expectations which are very, very important, and we feel that in the Union Budget 2026 these should see light of day. And most important among them is Section 87 capital A on rebates. Now, last budget 87A was amended. Even in the earlier times in 2024, from July, there was a lot of litigation because the ITRs allow long-term capital gain, short-term capital gain, and incomes taxable at special rates to be a part of the relief of rebate under Section 87A. But thereafter, there were various writs which were filed by in the high courts, and finally, the ministry had allowed the long-term capital gain and short-term capital gain and other special rates of incomes to be included in the relief for the rebates under 87A. But thereafter, they have amended Section 87 capital A, read with Section 115 BAC for the new regime, and they have made it clear in the last budget that when you are claiming relief under 87A, that is a relief in new regime from 4 lakh to 12 lakh rupees, or in the old regime also to an extent, long term capital gain, short term capital gain, or any other special rate of incomes, that would be excluded for the purpose of calculating rebate. So in case of, say, new regime for financial year 25-26, whenever you are filing the returns till July or September in 2026, you will have to pay the tax on any special rate of income, even though your total income is less than rupees 12 lakh, which was the guaranteed amount of tax free income under the new regime. So in this budget, there is various recommendations from various industry associations that, considering the fact that the country is looking towards increasing its consumption in the politically charged geopolitical space, and India has to today rely on its own consumption, this exclusion of special rate income from the rebate, this would deter the people from consuming and liquidating their investments, and therefore this needs to be relaxed. In long term and short term, the capital gain space, a lot is expected in this budget. First, holding periods, 12 months for equity oriented investments, and 24 months for property, gold, silver, non equity and non listed investments. In our view, and we have suggested to the government that now, when the indexation is not there, then there is no uh, relevance of two holding periods, 12 months and 24 months. The holding period for property, gold, silver, and all other asset classes, that should be the same as the listed security assets also. This would bring more money into the system. money into the system. Also, this capital gain rate, which was increased from 12 to 12.5% without indexation. Now, no capital gain would be available with indexation. So, this increase in the long term capital gain rate, this I would say is not the right way in case you want to put more money and to increase the domestic consumption. Yes, increase of short term capital rate gain rate from 15 to 20%, that is understood and that is acceptable also, so as to deter people from speculating and trading in the investment classes. Buyback. In July 2024 budget, the share buyback provisions had seen substantial amendments by introducing section 222F. Now, in case you as an investor have got money from the companies who are buying back their shares. Very recently, Infosys had bought back their shares, and many other companies have bought back their shares. So, if you are an investor and you get money from the share buyback for the shares which you are holding, then it would be treated as deemed dividend under 222F, this newly introduced provision from 2024. However, the major uh, glitch is that the cost of acquisition of those shares, that would not be allowed as a deduction from this amount which would be taxed in your hands. That would be carried forward as capital loss and would be set off going forward when you sell the balance of the shares in case they are available. Otherwise it would lapse. So this is I would say a deterrent to the buyback, and it is a deterrent for the companies who are doing well to buy back their own shares and increase the value of their shares further. So in these times where as it is the investors are shaky, as it is the companies are under stress, those companies who are actually doing well, this provision would deter the companies from buying back their shares and increasing the value of their shares further. So we have recommended that this clause wherein the cost of acquisition of the shares, that would not be allowed as a deduction from the dividend under 222F to be set off, that should be done away with. In this budget we are expecting this change. Also, the exemption under section 112A, that is 1.25 lakh rupees, that is expected to be increased at least to 1.5 lakh to put more money in the hands of the people. Again, some litigations have gone on across the year, and we expect that the government might bring in the consequential amendments to set to rest litigations which actually have no value for the government also, and these kind of litigation actually make the tax environment certain. Now, for example, there's one big litigation which has gone on over the last 1-2 years, is that in case you are selling, say, a property or another asset, and you are investing in a under construction property, and you invest the whole money within 3 years as allowed under section 54 for 54F. However, the developer does not give you the handover of the property within 3 years. He gives you the handover after 4 or 5 years. Then there is nothing under your control. And even the courts have held in India that in case the taxpayer cannot control a particular transaction, then the consequential relief should be provided. So in case the taxpayer has invested the whole amount of gain or the sale proceeds, and due to the default of the developer, which is not in the control of the taxpayer, this exemption under section 54F, this should not be disallowed to the taxpayers, and this litigation possibly in this budget it is expected may be put to rest by making the relevant amendments under section 54F. Interest under section 234C, that again is disputed many of the times when we are filling the ITRs, etc. Now, for capital gain and other certain incomes which are generated during the year, again, it is impossible to predict such incomes or gains which happen during the year at the beginning of the year and pay advance tax on that. So, for example, you are selling shares, gold, silver, etc. now in January 2026. How in April 20, July or June 2025 you can predict that you would be having that gain or income? So for these incomes, interest under 234C should not be leviable under any circumstances. Although in the ITR there is now a quarter-wise place in where quarter-wise you can disclose the amount of income generated, but still there sometimes during assessment under section 234C interest is leviable when on advance tax on these amounts. So here we understand that under 234C also there would be certain relaxations to set to right this litigation. A very, I would say, out of box suggestion or recommendation from many industry associations uh, on the high pitched assessments which is done is that there should be a arbitration or mediation mechanism in tax laws also, wherein the department and the taxpayers can come together and they can settle their disputes without going into unnecessary litigation which has not much value for the department or the taxpayer. So possibly this, and along with this club, the fact that even the tax officers, whenever there are high pitched assessments, they should also have some kind of accountability where in case the success rate of this high pitched litigation in the tribunals or the courts, that is very low. So these are some suggestions to reduce the litigations which although the government wants to reduce, but then it keeps on increasing on newer grounds. On the in the MSME space, we have been advocating for the past 3 to 4 years. Even this time, possibly, the MSMEs, they all operate many of the times or maximum of the times, I would say, through partnership firms and LLPs. But the tax rate is 30% in comparison to companies where the tax rate is 25% under the new regime. So it is always recommended to the government that these partnership firms also, they should be brought under the 25% tax bracket, just like the domestic companies are brought. In TDS also many amendments are expected. We have been advocating that there should not be this TDS certificates requirement. I mean, that is no use. In fact, we represented before the Honorable CBDT member also, Mr. Mishra, when he was we interacted with him. Uh, Although the department has a contention that under section 205, in case you have TDS certificate and in case the TDS is not paid by the deductor to the government, then recovery would not be made against you. However, the deductor who actually does not pay to the government, why will he give me a TDS certificate at all? So even to that extent, issuing of TDS certificates now, when TDS credit is allowed only to 26AS form, that does not have much substance in our view. Also, if you see the video of our last symposium, the second symposium we had on this income tax, we had discussed that the last date to rectify the TDS return, that has been reduced in Income Tax Act 2025 from 6 years to 2 years. So effectively till 31st of March 2026, you have to rectify all the TDS and TCS returns till Q3 of 23-24, quarter 3 of 23-24. All of them will get time barred for rectification from 1st April 2026 in the new Income Tax Act 2025. Now, it is proposed and recommended before the government that this reduction in the TDS return rectification timeline, this should be reinstated to 6 years, because already this provision for rectification of TDS return, earlier there was no time limit. Limit was earfenced to 6 years. Now, within 2 years to remove it, or reduce it to from 6 years to 2 years, that is a little burdensome on the deductors, and therefore we recommended that this period of 6 years should be reinstated again in the Income Tax Act 2025. So this was it from the budget 2026 expectations part. Now we go on to the most talked about dispute and the Honorable Supreme Court judgment in the case of Tiger Global, and how it impacts the global tax structuring and the Mauritius route. What is the Mauritius route? We'll also understand. And for all those practitioners who are, and all of you who are privy to issuance of Form 50, continuously we issue Form 15CB as chartered accountants to the various taxpayers, whether they need to deduct or not deduct TDS. So for those CAs who are issuing Form 15CB, and for those industries who are taking Form 15CB, even in that provision under section 195, this Tiger Global judgment would be very, very important, and you may have to rework on your Form 15CBs also. So we'll discuss all of that. Now let us just understand in brief, because we have many other topics to discuss. So just understanding in brief, in very simple terms, Tiger Global judgment and what is the Mauritius route which the multinational companies take. So in this case, as you can see on your screen, there were three companies: Tiger Global International, 2, 3, and 4. They had the holdings of Flipkart Singapore, right? So TGI, Tiger Global International 234, they had the holding of Flipkart Singapore, in short FS. Now Flipkart Singapore, that is FS, has the holding of Flipkart and other companies in India, right? So TGI Mauritius had holding of FS Singapore. FS Singapore had holding of Indian company, right? Now TGI 234 in Mauritius, they were formed in Mauritius as pure investment companies. They had a board of directors with 3 directors, one of whom was a USA citizen. They had a bank account in Mauritius where the directors were check signatories. They had even 2 employees and an office in Mauritius. It is not that they did not have any office in Mauritius. An office and 2 employees also. On this basis, they had taken a tax residency certificate, TRC, in Mauritius from the government of Mauritius and the revenue authorities there. Financial statements were prepared for TGI 234 and they were audited also in Mauritius. Now, this entire structure seems a very, very commercial structure, right? The Walmart purchased Flipkart and purchased the shares in Flipkart Singapore. After this, TGI 234 in Mauritius, they sold their shares of Flipkart Singapore. And consequently, the foreign company with the PAN card, TGI foreign company with a PAN card in India, they went to the Indian AAR that, gentlemen, this my company in Mauritius, it is selling the shares of Flipkart Singapore, which derives its value from the companies in India. Therefore, the capital gain at source is arising in India. However, it is to be taxed in Mauritius because of a circular and the double tax avoidance agreement before 2017, right? And therefore, you give me a nil TDS deduction certificate under section 197, right? So this was the entire transaction. Now, let us come again on the facts. Although TGI was formed as an investment company in Mauritius, it held the investment only of Flipkart Singapore. Why, in case you are an investment company, why would you invest only in one company, that is Flipkart Singapore and related companies? While TGI had 3 directors on its board, the director in United States, he had the authority to conclude the deals over 2.5 lakh dollars only. The other 2 directors who were there in Mauritius, they did not have the authority to conclude the deals over 2.5 lakh dollars. And this director in United States, while he was not there physically in Mauritius, he was also a signatory to the bank account in Mauritius. Although 2 employees were there in Mauritius for this company, however, these 2 employees and the small office in Mauritius, that was by and large not concluding or not executing any commercial activities or substantial commercial activities in Mauritius, but only holding these shares of Flipkart Singapore. Now, basis this, the Honorable Advanced Authority in India, they said that, gentlemen, your head and brain of your Mauritius company TGI 234, that lies in United States of America. Therefore, this DTA between India and USA, that would not, India and Mauritius would not prevail. The DTA between India and USA would prevail. And there was a circular that in 1994, that in case a company which is resident in Mauritius, that has shares of an Indian company and it sells or alienates with its shares of the Indian company, then the capital gain would arise in Mauritius, right? This was amended after the protocol for amendment of Convention of Avoidance of Double Taxation between India and Mauritius in 2016. So from 1st April 2017, even this was amended. They said no, the capital gain would comply with the source rule. Wherever the capital gain arises, in case you are old Mauritius company is holding shares in India, Indian company, and capital gain arises in India, the Indian tax authorities will charge the tax. But before 2017, all the transactions which have happened, they were considered to be at status quo. It is called grandfathering. So they were grandfathered, right? Now, the Honorable Supreme Court has held that this tax residency certificate, this was not sufficient to prove that control and management in a particular company that rests in that country where the tax residency certificate is provided. It has distinguished in this case and said that the control and management of the Mauritius company was in USA. And TRC is not a conclusive evidence of residency. You have to see the commercial substance also in a transaction. So as accountants, we have always heard of this principle of form over substance. So the Honorable Supreme Court has held that the commercial substance has to be seen over the form of the transaction in the form of tax residency certificates in a particular company. And second important decision, Supreme Court has held that GAR and domestic law override the treaty. Over the last decades, we have already always understood that the double taxation avoidance agreement treaties, they override the domestic law. But in this judgment, the Honorable Supreme Court has said that the GAR and domestic laws both override the treaty benefits in case it can be uh, proved that the structuring is only for tax avoidance. So, friends, now that the Supreme Court has already ruled this in this Tiger Global judgment, now nothing much can be done. But what we can always think is the way forward. Now, companies' way forward is that companies should now have to strengthen the commercial substance of a particular transaction rather than just looking at tax structuring, right? They have to see that where the control and management is, in which country. They have to see that a particular company is just not a conduit company, and they have to reevaluate their GAR and domestic law position also. Now, important is, what about before 2017? What will happen to those cases, whether grandfathering would be assured or not for the pre 2017 cases, right? In my view, for the grandfathering also, number one, as the Supreme Court has held, grandfathering was only there where there was a direct holding of a Mauritius company in an Indian company and not an indirect holding. So in case there is an indirect holding, which is there in many of the cases, then absolutely it will not prevail. And otherwise also, grandfathering also, in my view, may not be assured even prior to 2017. So what does it hold for you, chartered accountants and companies who are taking Form 15CB? Now, in November 2025, there was a dispute where the Honorable Supreme Court has held in the case of Murli Krishna Chakrala, right? That chartered accountants cannot be implicated for issuing Form 15CB and holding that no TDS can be deducted where there is an intention of evasion, right? The chartered accountant's obligation does not constitute abatement in money laundering cases, right? So the Supreme Court has actually provided relief to the chartered accountants who are signing Form 15CB from money laundering cases. However, after this Tiger Global judgment, issuance of Form 15CB, that becomes all the more crucial. See, three documents we generally take, right? Three documents we generally take for issuance of Form 15CB. What are the three documents? We take the tax residency certificates. We take Form 10F for further declaration of the details of the persons or the payees. And we also take a no PE certificate, right? These are the three documents which we generally take while issuing Form 15CB. But Honorable Supreme Court in Tiger Global judgment has held that this TRC is not a conclusive proof. So no PE and Form 10F would also come in that. Now, how do you as a CA who is issuing Form 15CB certificate, how do you ensure, specifically when you are stating that withholding tax is not applicable, how do you ensure that you are protected? In my view, you must take from the payee a certificate also that the pay is controlled and management in the country from where it has received the tax residency certificate also, right? So that would, I think, uh, obligate you as a CA or even the company who is issuing Form 15CA and taking Form 15CB from future exposures. So this is by and large this Tiger Global judgment and the issues therefrom. Now, when we are talking about the Tiger Global judgment, another example comes to my mind, that is bill from ship from in case of services. Now, say for example, you are taking a service from a USA company, and the USA company is taking the same service from Hong Kong company. You are getting the service from company, but you are getting a bill from the USA company who is your actual supplier. Question is, while signing form 15CB or while looking at the tax provisions, whether look at the DTA of US services. Well, in my view, and also as provided by the Honorable Gujarat High Court, that the right, important development, friends, is this Supreme Court's another judgment in case of amalgamation. I would explain this transaction and the implications in very, very simple terms for all the people who are holding shares and they get a swap, a share swap after amalgamation. So, suppose you are holding the shares of company A. Now, company A amalgamates into company B, and you, as a shareholder, get the shares of company B as a swap for the shares of company A, right? The question is whether, in case the value of your shares, the market value of your shares of company B, which you get as a swap for shares of company A, if that is more than the earlier value, which generally is there in many times in amalgamation cases. Question is, when do you need to pay the tax? Do you need to pay the tax when you get the new shares, or do you need to pay the tax when you sell the new shares? So as of now, the position stands that this swap shares, which you new shares which you get in case of amalgamation as a swap, that uh, is the capital gain which is arising on that, that would be considered as not taxable under section 47, 47 subclause 7, right? Because that would not be considered to be as a transfer. It is just a mere substitution of the shares. Now the question is, if you are a company and or if you are a business entity, and if you hold this share of company A as stock in trade, then the situation changes. Then you get into the trap of section 28 subsection 4. Now we have discussed 28 subsection 4 very, very elaborately in 2020-21 when section 194R TDS has come. Now this 28.4 is a very critical section in PGBP chapter. It says that you need to pay tax even on benefit or perquisite in kind, right? So in this case, in case you hold a stock in trade, these shares, then this becomes, this increase in the value becomes benefit in kind, and therefore the Honorable Supreme Court has held that this, in case you held these shares in stock in trade and in case you get new shares for as a part of amalgamation, then you need to pay the tax on the profit earned. We all know accounting standard 1, which is also there replicated in ICDS 1, that the payment in the BBGBP, the tax would be levied under PGBP and the profit would be calculated on profit earned, right? Accrual basis, what we commonly say. Therefore, three-step text. Whenever there is an amalgamation, you are holding the shares of the amalgamating company and you get new shares of the amalgamated company, then you have to take three-step test. Number one, whether you are holding the shares as stock in trade, your balance sheet, your previous history, board meetings, etc., that would reveal whether you are holding the shares as stock in trade or not. Next is that whether your new shares have value. In case it is a non-listed shares, that there is no definitive value. And third is that it is possible to immediately dispose of the shares. Specifically in case of listed shares, it is immediately possible that you get the amalgamated company shares and dispose of. So in case the shares are held in stock in trade, they have value and they can be disposed of immediately, then you need to offer the tax when you get the new shares. Now again, in amalgamation, there is an appointed date, there is a court sanctioned date. But when you get the shares, that is the time when you get the shares in your demat account. That is the time when you need when your taxation arises in case there is a gain due to this share swap. So this is a very, very important again judgment of the Honorable Supreme Court in Jindal's case, which changes the landscape for the shareholders in case they are holding shares of an amalgamating company. Another very important development over the last 2 years is nudge, non-intrusive usage of data to guide and enable. The CBDT is carrying on with the nudge campaigns. Many of the taxpayers, they are getting emails from CBDT and SMSs that in case you have taken a wrong deduction, specifically in case of political deduction, a political contribution is made by you and you're taking a deduction and under chapter 6, or in case the CBDT has gotten information from a foreign jurisdiction, apropos automatic exchange of information program of the Indian government with the foreign government, that a Indian resident is holding assets or earning foreign source of income outside India, then you need to disclose it. They are propelling the taxpayers to revise their returns. Now, what in case you have not revised the return till 31st of December 2026 and you are holding these foreign assets, or you have a foreign income, you are a resident, or you have taken a wrong deduction knowingly or unknowingly. Friends, many of the times ITRU, we maybe many of the times as taxpayers or as consultants also, we feel that this ITRU, that requires additional payment of tax of 70% if it is older than 4 years old, it's 60%. If it is 3 years old, if it is 4 years, 70%. If it is 3 years, additional 60% tax. If it is 2 years, additional 50% tax. And if it is within 1 year, additional 25% tax. But this is not correct. This 70, 60, 50, 25, this percentage is actually on the tax and not the taxable amount, right? So on your screen we have done a computation. Very recently a client had come to us. He had certain foreign source income in foreign jurisdiction. We advised them that, gentlemen, see, you can revise your return. He had some foreign source income in financial year 23-24 and 24-25. We said, gentlemen, see, now this the information will flow to the CBDT going forward, right, from foreign jurisdictions, even if it has not flown now. So best way is that in the assessment year 25-26, what we did, that we revised the return for financial year 24-25 foreign source income, and for financial year 23-24 the income, that was a small amount in 23-24 also, which escaped taxation. So we actually filed an ITRU. And what is the excess amount? So we have done the calculation even on interest. So on your screen you can see the fifth row for financial year 24-25. Your normal rate of tax is 31.2% after education cess. Interest also 12%. We are taking the interest on advanced tax component also. So interest would be 3.7% effectively. at the rate of 12% per annum. Total amount to be paid would be around 35%. And additional tax would be 25% of 35%, right? Which is around 9%, right? So the total tax which that person was paying was only 44%, right? And this is inclusive of interest. Similarly, if you have 100 rupees payable for the last 4 years, every year 100 rupees, 5 years, then effectively you will be paying 292 rupees, 60% extra, which is much less than section 115 BBE, where the additional tax, only tax, not interest, is 78%. So this ITRU, in case a client or in case you are a company where you feel you need to come clean, ITRU is a very, very good option. Already 2,500 crores has been collected by the CBDT wide ITRU. Now we come to bogus purchase. Now, bogus purchase allegation by the department is very, very common in today's business environment, specifically after GST. After GST, I think by and large every business has some disallowance under GST law. So now, in case there is you admit a bogus purchase under GST law, that is why it is very, very important now that this exchange of information is happening. So under GST law, if you admit a bogus purchase, right, that the information will come to the income tax department, and income tax department automatically will issue you a show cause notice, right? Now, the question is that even under income tax, if you pay the tax component, then there would be a penalty component also which would be coming. So the question is, let us understand how to defend the bogus purchase. Number one, in case you have admitted already the tax amount. See, first of all, it is now tried that just because of the GST department's intelligence or income tax intelligence, also the assessing officer cannot just create a show cause or a demand of bogus purchase. He has to conduct his own inquiry. Now the department, there was a lot of embarrassment to the Gujarat income tax department also, where on the basis of a GST department's alert, they issued a bogus purchase show cause in income tax, and then GST department had to withdraw the notice, and they also had to withdraw, the income tax department. So the income tax department, just because they get alert from the GST department, they cannot also issue a notice. They have to, AO has to conduct its own inquiry. Again, now in one of our cases which we in Tax Connect handle, now this is a very different case. One of the taxpayers, he filed his return and instead of 10 lakh PGBP income, he disclosed 1 crore, 10 extra. So then we revised the return. He came to us what to do. He was in huge panic and he revised the return. We revised the return, and thereafter he got a show cause. So we replied that yes, there was a typo error, and there are many case laws, including the Madras High Court case laws, in case of short dues, that in case of typo, then there would be no imposition of tax. But he filed the return under presumptive taxation under 44 ADA, and he took a deduction of 50% expenses, deemed expenses. Now the question is, he took a deduction of 50 lakh when he filed his original return, because he disclosed income as 1 crore rupees. Now the income tax department required to submit reply as to what happens to this 50 lakh expenditure. How can you reduce your expenditure also? Now that we substantiated it with bank account. So the income tax department was just on the verge of invoking section 69C on unexplained expenditure, so to say bogus expenditure. Then we substantiated with bank account, and also the case laws in the case of Amitabh Verma by the ITAT Hyderabad, that in case of deemed income in 44 ADA, the presumptive taxation, the expenditure can also be deemed. And we substantiated with bank account that, see, we have no such expenditure. In fact, your assessment was also wrong, where you allowed that 50% expenditure when it was not that. So we got a relief at the CIT appeal stage itself. But what is important whenever you are applying under presumptive taxation is that you must prepare a bank summary and balance sheet. Otherwise, how do you defend bogus purchase? Friend, we have a 4-step mechanism. First, you as a taxpayer has to defend any allegation of bogus purchase. How do you defend? With documents. What are the documents? Invoices, stock register, lorry receipts, delivery challan, weighment slip, kata slip in sensitive sectors like metal scrap, etc. Bank statement, correlation with sales. You have to show that the material purchased, which is the allegation of bogus purchase, has actually been sold. If it has been sold, where is the question of bogus purchase? E-way bills, sales register, GST returns. And again, in the sensitive sectors like metal scrap, etc., we tell the taxpayers to even have the photo, video of the stock when you receive it, the statement of the drivers. Many of the time, the vehicle drivers input output ratio, electricity consumption, relation of the production with the electricity consumption. Now, all of this, in case you can substantiate with documents with the bogus purchases, then the owner shifts on the AO. Now you ask the AO that you prove that how you are substantiating your allegation of bogus purchase. Even if he brings a data entry operator from whom he has taken a statement, just the admission by a data entry operator cannot substantiate the bogus purchase allegation. So this, in our view, that in case there is a genuine purchase and in case department alleges bogus purchase, and many of the times department alleges bogus purchase just because you see the person, the supplier has not filed his GST ITR returns, right? Just because supplier has not filed his ITR returns, it cannot be the allegation of bogus purchase. Now, even in case a data entry operator, now I'm taking it one step forward, even in case a data entry operator has accepted a data entry mechanism, then the commission would be 0.5% as held in by many courts, Vikas Gupta case by Delhi High Court, etc., etc. So friends, again, there are many summary disallowances of business expenses, promoters salary, rent paid to directors, etc. All of this puja expenses, the many of the tribunals, they disallowed puja expenses. All of this you have to deal with by showing commercial expediency. How you can show commercially this expense is required, and you can also show that the other party, counterparty, has offered it for taxation. TDS on foreign agents, again after this Tiger Global judgment, TDS becomes on specifically under 195 by issuing of form 15 CB. Now that becomes critical. Now in case of foreign agents, the trite law which is settled is that in case the foreign agent has no PE in India and he performs all his services outside India, then no TDS should be deducted. After this Tiger Global judgment, in our view is that even after this Supreme Court judgment, which is in the favor of taxpayers in the case of Toshoku Limited, even then you must take a declaration from the service provider that he or she is controlled and managed only in the country from where he's got his TRC. Last, on the charitable institutions, again, many of the charitable institution trusts, etc., their exemption is challenged by the authorities. uh, Now, in charitable organizations, the exemption under Section 11 and the certificate under 12A, that is challenged mainly on two accounts. Number one, in case the organization, this trust, has an income of more than 15%, accumulated income of more than 15%. And number two, that their commercial income, it is more than 20%, right? In case of GPU, right? Now, generally, after this order judgment, those of you who are doing trust, they would remember in 2022 there was a judgment of the Honorable Supreme Court in the case of Ahmedabad Urban Development Authority, where the Honorable Court has held that even the under GPU, you cannot have a lot of income, you cannot have a major income from the commercial activities. You can have little income. How much is that little income? That was not very clarified in that judgment. After this, some institutions trust, they have got show cause notices. But actually, friends, if you see this ITAT Bangalore decision in the case of Dharwad Growth Center, actually order judgment is in your favor. In this, the Honorable ITAT has actually held that the order judgment very clearly states that the charitable institutions like Chamber of Commerce, etc., they can actually have some commercial income also to the extent of 20%, where they can make profit, but there are certain conditions that the profit cannot be withdrawn, they cannot be distributed as dividends, and the object of the organization should be charitable, and the commercial activities should also focus on uh, the focus on supporting the main objects of the organization. If that be the case, actually Ahmedabad Urban Development Authority judgment of the Honorable Supreme Court comes to your rescue to an extent. So friends, this was it from my side. We have another speaker, Rohit is also there, who will deliberate on the Income Tax Act 2025 implementation. So from my side, thank you very much, and over to you, Pooja, before Rohit takes over.
Thank you, sir. The session was very interesting, and we get lots of insights that are very much important for the practical practitioners who are doing practice in the income tax and the challenges that they have faced post these remarkable judgments like Order and Tiger Global. So I have two or three questions only in this regard. So, like post Supreme Court ruling of the Tiger Global, how should existing and future investment holding structure that is rooted through Mauritius should be evaluated from the substance, treaty protection, and risk assessment perspective? So
Yeah,
you are on.
I'm
Yes,
audible, no?
yes. Now you are audible.
See, after 2017 protocol, right, on this avoidance DTA, the Mauritius route is by and large closed, right? Because the treaty, the protocol itself has said that the capital gain will comply with the source rule. Wherever the asset is there, that country would be liable to that country would be eligible to charge the capital gain, right? So Mauritius route is gone after 2017. Now, even otherwise, I would say these commercial substance test, that is very, very important, right? You cannot have just a conduit entity.
Mhm.
If, like in this case also, the major thing which came up is that the head and brain of the company in Mauritius, that is lying in United States. The two employees over there, they are doing by and large nothing. If there is an investment, why there is an investment of that company only in one company in Singapore, right? If it is an investment company, so you have to be more commercial, you have to have commercial substance whenever you are doing a transaction or transaction structuring. Just don't do it for tax planning, That is what comes out of this Supreme Court judgment.
Okay, sir. And sir, because of this judgment, by citing this particular judgment, can officers reopen the past assessments also? Is it
Hmm.
possible, or is
This
any
is
chance?
now this is the billion-dollar question, right? See, generally there is a chain holding, right? Generally, what is seen even when there was Mauritius route before 2017, there was a chain holding, right? Mauritius to some other companies, to some other country, to India.
Mhm.
Now, the Supreme Court has distinguished that case. Even before 2017, the Supreme Court has distinguished the circular of 1994 that see that circular is very clear that it has to be a direct holding. In indirect holding cases, even that circular, that alienation rule will not prevail. So, to that extent, grandfathering would not prevail, right? Even before 2017. Even otherwise, even if it is a direct holding, the Supreme Court has held many issues and commercial expediencies, GAR, and domestic laws, specifically GAR. One has to see GAR before taking a call, and the department may reopen cases on GAR.
Okay. Thank you, sir. Sir, my other question is related to this bogus purchase that we have discussed at that in the last of your session. So many times there is a third party information involved in such bogus purchase. And if the assessee is not given any opportunity of cross examination, so from the litigation standpoint, can such information will sustain as an addition?
Not sustain. See, but there is a judgment in the case of Andaman timber. That judgment would prevail. Just as I said, mere data entry operator statement will not prevail. If the department is relying on a data entry operator statement, there has to be given an opportunity of cross examination.
Okay. That's all for the session till now. So we can start with Rohit sir.
Yeah. Thank you, Pooja. Thank you, Vivek sir. Good morning, everyone.
Sir.
I hope my screen is visible.
Yeah, it is visible, Rohit.
Yes. So today we are here to discuss the most significant tax reforms, that is transition of from Income Tax Act 1961 to Income Tax Act 2025. We all know that this Income Tax Act 2025 has been passed on 21st of August 2025, and it is going to implement from 1st of April 2026. So we are only approximate 2 months away from the date of implementation. So this financial year 25-26 will be most critical period to prepare ourselves for transition to the new Income Tax Act. While this implementation will be done, there are some questions in the mind of the SSEs, like what happens to return file till financial year 25-26? How to file returns for 25-26, whether it will be in the new form or in the old forms, that is forms notified in Income Tax Act 1961. We all know that rules, forms, procedures are yet to be notified by the CBDT. However, once these forms, rules will be notified, this clarity is expected on the same. Like TDS returns for Q4, this will be most critical, that how this return will be filed, because this will be filed after implementation of Income Tax Act 2025. What happens to refund, which has already sanctioned? TDS credit, MAT credit, AMT credit, carry forward of losses which has been reported in returns, carry forward of unobserved depreciation. What happens with the exemption granted to the trust, NPOs, whether the old exemptions will prevail, or there is a separate procedure for applying for new exemption certificates. There has been choices made by the corporates in the form 10IA, by the individuals in form 10IE for claiming reduction of benefit in the tax rates. Whether these choices will continue in the new Income Tax Act or there is a new procedure in the new Income Tax Act. What happens to assessment, reassessment, which will be commencing after 1st of April 2026, but relating to financial year 25-26 or before? Whether jurisprudence which is related to ITA 61, like decision of Honorable Supreme Court, various high courts, whether this will prevail or there will be a new evolvement of jurisprudence. Can reopening be done on the basis of judgment of a court under Income Tax Act 2025, even in case similar matters is settled in ITA 61? So these are the critical questions which SSCs are having in their mind. So CBDT has provided section 536 in new Income Tax Act 2025, and similar provision was already there in section 297 of Income Tax Act 1961. This provision is for discussing about repeal and saving clause. So this will be helpful for this transition period. While we are in the transition period, we need to take care. What we need to do is we need to file our income tax return for financial year 25-26 with very due care, so that the transition in the new regime will be smooth. The last return of financial year 25-26 for last quarter, the TDS return, that should be filed with due care so that no anomalies there in transition. In case any notices for IT return for financial year 25-26 or TDS return for quarter 4 25-26 to be settled before the new regime in case possible. In case any replies to notices of or any queries relating to ITR or TDS return is pending with the authorities, that should be complied before this new implementation so that the transition will be smooth. This section 536 is which is repeal and provisions. It clearly specified that the new law will not affect the previous operation and orders that is already done. Like if any order passed under the old act, that will prevail and be contested under the old act only. All procedure for assessment under chapter 14 of the Income Tax Act 690 ITA 61 would be conducted for all financial year before 1st of April 2026. Any right, privilege, obligation or liability under the repealed act, such repealed act, it seems that refund sanction would be received under ITA 61 if it is related to ITA 61 financial years. Any appeal filed under ITA 61 would be filed for all financial years as per the provision specified in ITA 61 and not under ITA 25. If any demand under ITA 61 would prevail, it required to be paid as per the procedure specified in ITA 61. That seems to be the intention of the new law. Any proceedings which is already initiated, that should continue to apply in respect of any period which is before 1st of April 2026. So it can be interpreted that any payment of taxes for financial year 25-26 shall be made under ITA 61 as per the challan prescribed under ITA 61. That can be interpreted. Any assessment and appeal for old period, old forms need to be filed, not the new forms. In case any penalty is to be imposed or has been imposed under the ITA 61, that penalty proceedings shall continue as per the procedure specified in ITA 61, even if after implementation of ITA 25. Any proceedings, application, appeal that should be used in the process specified in ITA 61, any advance pricing agreement to be disposed of under the old act if has been applied before 1st of April 2026. any option election declaration made either in Form 115BA, BAB, BSc, Form 10IC, Form 10IE, etc. should continue to operate, which can be interpreted from the transitional provision, repeal and saving provisions. Any notice issued before 31st March not replied, it would be valid and replied under ITA 61, even if after implementation of the new act. Whether any refund falls due, any default is made, any interest is payable under the previous law, that is ITA 61, that should be processed in the procedure specified in ITA 61. Now, the question may be arise in the mind that in case interest is due for refund to be received, then two rates will be applicable. One that is before that is as per ITA 61, and next is ITA 25, because there are two different laws under two different regime. Whether any payment which is relating to for the financial year 25-26 or before that, whether this payment is to be made after the due date, whether interest to be calculated under the new law or under the old law. Now, in case payment has been made after 1st of April 2026, which is relating to financial year 25-26 or before that, we are expecting that separate challan format will be there in the new law. So, whether which challan is to be used, whether the old challans or the new challans, this is yet to be clarified by the CBDT. Where any deduction has been allowed, subject to fulfillment of certain condition, and going forward it has been assumed that no, this condition has not been fulfilled, then that will be added in the total income of the taxpayer. For example, in case there is a long-term capital gain on which exemption has been cleared on the basis of investment made in as per procedure specified in section 54F of ITA 61. Now, that procedure is saying that net said consideration to be reinvested within the prescribed timeline. In case there is a violation of this condition, this will be added as an addition of income under ITA 61 or ITA 25. This is to be addressed. Various jurisprudence which already been decided under ITA 61, whether the same precedent will be applicable for ITA 25 or there is a new evolvement under the ITA 2025, that is to be looked into. Any agreement which is approved, instruction, notification, order, rule issued shall continue in force. Now, we recommend or we suggest that in case you have applied for APAs, then you should get it closed before 31st March 2026. A question may be arise that all the circulars, whether issued in ITA 61, will continue to force in ITA 2025 or not. Now, in the repeal and saving law provisions, it is clear that if it is consistent with the provision of ITA 25, then it will be applicable, otherwise not. In case, for an example, we are taking example of section 194R, which is a TDS provision of ITA 61. That 194R requires deduction of TDS on any benefit or perquisite provided to a resident in the course of business or profession. By issuing circular number 12 and number 18, the CBDT has clarified that okay, this deduction of TDS is not required in case of trade discount, cash discount and postal discount. Now, this relief and relaxation has been provided by issuing a circular, not through amendment of the Act itself. Now, this TDS provision, when it comes to ITA 25, whether this relief which has been provided through the circular, whether this will be continued or not, prima facie it seems that no, this relief should not be applicable. So we are expecting a separate procedure or relief shall be pronounced in the after implementation of ITA 2025. Any credit which is available as MAR credit or any TDS credit, which will be carry forward in the procedure, which we are expecting in the rules. Any amount of loss and brought forward, which is reported in return as carry forward, where how it will be carry forward to the new regime, that we are expecting in the route itself. Any bad debt which is carry forward, that again is to be carry forward in the procedure specified. So we need to take care at the time of filing of the last return in the financial year 25-26, so that this carry forward will be smooth in the new law. So we understand that implementation which is to be done in coming years, so that the transition can be adapted in a smooth manner. How this transition can be implemented? First, we need to do impact analysis under the ITA 61 provisions, as well as per the provision of ITA 2025, so that corrective and required procedure can be adopted immediately. We need to discuss internally, do a meeting with finance and tax team regarding the transition provisions, changes in new Income Tax Act 2025, return filing procedures after this returns forms will be notified, payment procedures, so that the new team will be ready from the day one for implementation of the new law. We need to analyze internally impact of continuing assessment, appeal, offences and penalties which are going on for the ITA 61, so that the required procedure can be adopted in ITA 2025. Changes in income tax portal. Presently, the income tax portal having the feature of ITA 61 and the design accordingly, we are expecting that a new portal version 3 is expected after implementation of ITA 2025. So that will be designed in a manner as per the provision of ITA 25. Training to the teams and update in the new system is also required. It is very important that the person who are involved in a day-to-day transaction recording is aware with the new implementation process, so that they are recording from transaction in the procedure specified from day one. New masters is to be created in the accounting system, so that accounting entries can be made as per the new law. For example, TDS sections has been changed, like 194C, 194J, 194A, various sections were there in Income Tax Act 61. In ITA 2025, table has been provided for TDS, so masters has to be recreated in the accounting system. That planning required from now, so that we are ready on 1st of April 2026 for the new law. Impact of TDS and TCS also to be taken care at the time of filing returns for Q4, so that any TDS which has been carried forward to next year will be taken care of. Impact of refund or liabilities should be planned, so that interest and penalties should not be attracted under the new law. We need to do computation of our income tax as per new law as well as the old law, so that a comparative analysis can be done. A benefit analysis can also be done on this. We are expecting that some transitional forms will be there. We need to plan for that also, so that the data will be ready for filling this transitional forms. We need to see litigation which were there in ITA 61, whether it will be continued in ITA 2025 or not. So before going live, we need to be ready and be very careful while filing the last ITR of financial year 25-26, filing the last TDS and TCS returns for financial year 25-26, while computing the advance tax on the first quarter of 26-27. We need to do computation as per the new provision, so that there will be no interest for wrong computation of advance tax or short payment of advance tax. We need to file first TDS and TCS returns, because there will be new forms. We need to be ready for that also, so that we are duly complied with the law. And first ITR will also be critical in the financial year tax period 26-27, because this will be the first return which is going to be filed in ITA 25-26. So we understand that we need to prepare ourselves from day one, so that there will be a smooth transition in the new income tax law. It depends on us whether we are taking it as a challenge or we are taking it as an opportunities. So this is it from my end regarding this implementation. Thank you very much.
Thank you, sir. It was a very detailed explanation that you have mentioned how this transition should be taken care of by the practitioners. So can we take question from the participants now?
Yes,
Yes,
please.
So I request all the participants, if they have any question on the topics discussed till now, they may ask in the chat box.
so I think everybody has understood everything.
Yeah, we are not having any question.
Right. Actually, I think people are also in festive mode. In fact, because yesterday was Saraswati Puja, today is Saturday, so there is and again Monday, extended weekend is
Correct.
there. People are planning for extended weekend.
Yeah,
But yeah, good that at least people joined on this webinar on this extended weekend.
right, sir. So, sir, Hitesh Sachdeva is raising the hand, I guess. Sachdeva ji, if you have any question, you may ask in the chat box. So, can we conclude it?
We
Because
can't can't unmute him. We can unmute him also.
Nivedita is thanking you. Thank you so much, sir. It's really very delightful.
Thank
Okay,
you. Thank
Sachdeva is also want to say thank you for the session. So, on this note, we are concluding this session, and I just want to highlight the few important things that we have discussed today. First of all, we have discussed that while structuring the cross-border transaction, the approach must go beyond the pure income tax optimization. A holistic perspective is essential that factors in substance, commercial rationale, and long-term risk management. And secondly, Sir has highlighted the practical challenges to justify expenditures where income is offered under presumptive taxation. Because under presumptive schemes, we do not need to maintain the books of account or keep the trail of all the expenses, but still we should maintain the data in a way in a reasonable trail to explain business expenditure, cash flow, and commercial prudence. And Rohit sir has very well explained how the transition from Income Tax Act 1961 to proposed Income Tax Act 2025, with a consensus that while simplification is the intent, professional must be prepared for the interpretational and transitional challenges during the initial phase. And we sincerely thank you to both esteemed speakers for sharing their valuable insights and practical perspectives,
Ma'am, we
which,
are getting some questions. I'm sorry to interrupt.
okay,
There are some questions coming up in the chat box.
okay, yeah, sure.
So if you can address.
Yeah, I think there is one question from Roshan whether TDS is required on payment by SEZ unit to another SEZ unit for contract work. So yes, I think Roshan, there is no exemption per se from one SEZ to another SEZ, but in case you need an exemption, you can always apply under this section 197 wide form 13 if you need a low TDS deduction certificate. But otherwise, there is no blanket exemption from TDS from one SEZ unit to another SEZ unit. Nikita is saying understand the amendments relating to bogus purchase linked to income tax. Especially, yeah. So this is a comment. Tarun is saying for section 54 deduction in relation to sale of a house, the period of 2 years possession has to be taken from agreement. Uh, construction or completed or possession. So yeah, that is what we discussed. Actually, the provision says it should be invested, right? Now the question is, which the department is litigating, is whether you have made the payment but you have not got the possession. So whether that would be construed as a compliance to section 54. In our view, the payment is important. The fact that number one, payment is made, and number two, original uh, the original period of construction, that should be below 3 years if construction, or possession within 2 years, right? So if those two are there, now if the developer delays, he takes another 1 year for construction, then it is not within your control, and then we feel that the matter can be adequately litigated. Okay, Mr. Akhil says, whether Tiger Global decision, will similar transaction involving India, Mauritius, D- DTA benefit need to be revisited under with respect to 15 CB? Yes, Mr. Akhil. I mean, that is the whole point, that 15, it has to start from 15 CB, right? All the transactions, I would say, under 195, where you are giving a certificate of no deduction, right? All of them have to be revisited to where the control and management is there. Although you are protected by the Honorable Supreme Court's decision, but you never know when that decision can be distinguished under and again, PMLA is one of the issues. The other issue is even the company that would also suffer in case a 15 CB is not as per the legal provisions. So 15 CB becomes very, very important. I think these are the questions, Pooja. Over to you.
Yes, sir. Uh, So we sincerely thank you to Vivek sir and Rohit sir for sharing their valuable insights and practical perspective, and which greatly enriched the session and provided meaningful takeaways for all the participants. Thank you so much, sir.
Thank you. Thank you, Pooja, for associating with us. Thank you to all the participants and Team Tax Connect for holding this webinar. Thank you. Thank you, Rohit.
Thank you, Vivek sir. Thank you to the participants. Thank you to the educated team. And thank you to the Tax Connect team also. Thank you very much.
Thank you, everyone. Thank you, Vivek sir. Thank you, Pooja ma'am. Thank you, Rohit sir. Thank you to all the participants for attending the webinar. We conduct such webinars every month, and we hope to see you in the upcoming webinars as well. Thank you, everyone.